In this lesson, we will discuss the various adjusting entries that are required to move from a cash basis of accounting to the more important accrual basis per Generally Accepted Accounting Principles or GAAP. Remember from our prior lesson that step 6 at the end of the period requires that we prepare our adjusting entries, of which there are 4 types. The 4 types of adjusting entries at the end of each period are as follows. First of all, we have prepaid expenses, which are the costs of the assets acquired in one period that benefit more than one period, in a period of time in the future. Such an example, that would be prepaid rent. We'll talk about that further. Next, we have deferred, or also they're called unearned revenues, which is when a company receives cash from a customer up front before the goods or services are provided to them. Example of that would be a hotel advance deposit. You have to put your deposit down before you actually come onto the property to stay. Third type of adjustment is an accrued receivable, which involves the recognition of revenue before the cash is received from the customer. Example of this would be a group function at, say, one of our Hershey properties. Somebody would come tonight to a function here at the property, and then they would pay us in probably 30 to 45 days after the event. Our last type is an accrued liability, which involves the expenses incurred but not yet paid. The most common, and pretty much every company has this, is a salary or wage expense example, where again, they may have incurred the wages now, but we won't pay them until the next pay period in 2 weeks or further down the line. Okay, over the next 2 slides, we're going to review the 4 types of adjustings a little bit further with some examples. First of all, under prepayments, let's talk about prepaid insurance or rent. These are the 2 most common prepaid assets of all, and we'll actually walk through an example here very shortly. Next, we have gift cards. Good example of that would be at Hershey. We sell gift cards, say now, that somebody will use in the future. So we'll walk through that example here very shortly. Next, we're going to discuss the accruals, the other 2 types of adjustments, cash after the recognition. First one would be an interest receivable. I earn some interest today, but maybe it doesn't get paid to me until a future date, 3-6 months down the road. And lastly, the most common is accrued payroll for accrued liabilities, which is a very common expense accrual where most companies have their payroll periods that do not match their month-end reporting dates. Does everyone think they understand these adjusting entries now? Tell you what, I'm going to move over to the whiteboard so we can illustrate how we could calculate several of these examples. Okay, we talked about these adjusting entries, so let's do a couple of real examples. The first one would be prepaid insurance. Let's say I have an insurance policy that I spend $24,000 on January 1st of 2017. Let's also say that that policy is going to last for 2 years, because it's very common that you pay for the policy up front. It lasts for a longer period of time. So here's the adjusting entry we need to do for each of the next 24 months. We would have to debit our insurance expense. That's an item on our income statement that we talked about for $1,000 or 1/24 of that total. And we would credit our prepaid insurance, which is a current asset on our balance sheet, for the $1,000 as well. What has happened? We've increased our expenses, which makes our income go down. We've also decreased our current assets on our balance sheet. That's the adjusting entry you would need to make in the case of a prepaid insurance or prepaid rent. Okay? Now let me take you through an example of the other example of adjusting entry would be in the case of, say, an unearned income, such as gift cards, right? We buy gift cards all the time, right? Usually right around the holidays is the most frequent. Let's say you want to come to one of our Hershey restaurants. So you buy your spouse a $100 gift card on 12/15 of 2016. Okay? Well, from a company perspective, have I really earned that revenue yet? No, because you haven't come to our property and experienced the dining at our property. So here's the entry I would have to make. First of all, I'm going to take your cash, right? So it's a debit to cash for $100. And by the way, cash is always good to record, right? And I'm going to credit my unearned income for $100. So that's basically what? A liability account. I owe you or your spouse a visit to our property and enjoy one of our dining options. When you actually come to the property, here's the entry I'll make. I'm going to get rid of the unearned income, right, that we just saw here for 100. And now that you've experienced the dining facility, I'm going to actually move that to earned revenue for $100. So let me just recap what we've done. When you come and buy the gift card, it's an unearned income, which is basically a liability account. I owe you a future benefit to that service. And then when you actually come and experience it, I'm going to remove the liability, so those basically cross each other out. And what I'm left with is I take your cash back in December. When you come in February to the property, I actually get to earn the revenue, which is basically an increase to my revenue and basically an increase to my net income. Folks, that's an example of an unearned income that moves to revenue in the income statement. The final type of adjusting entry involves estimates. There's two types we want to talk about. First of all, bad debt expense, which we'll cover later when we get into Chapter 7. Where basically we estimate the amount of uncollectible receivables. Very interesting topic. We know we're not going to collect 100% of our receivables, so we would have to deem an estimate of that in the future, what we will not collect. Second type of adjusting entry is depreciation expense. We'll cover that a little bit further when we get into Chapter 10. But this is the allocation of the cost of a long-lived asset. We typically call that property, plant, and equipment, or PP&E. An example might be a delivery truck that we buy today that we know is going to last for 10 years. So we want to kind of allocate that upfront cost of that asset over its useful life, which is basically the period of time for which those benefits will be received by the asset. The last topic in this lesson involves our closing process at year end. Steps 9 and 10 of that accounting cycle we spoke about earlier. Basically, all the temporary accounts, which are those income statement accounts, are zeroed or cleared out. That's why they're called temporary accounts. In essence, the net effect of the temporary accounts being closed out to retained earnings is that we're moving the net income over to the retained earnings on our balance sheet. Keep in mind that key formula, revenues minus expenses equals our net income.